Hey everyone, it's Mike Valtos from Orderflows.com, and thanks to NinjaTrader for having me on this webinar today. And today I'm going to explain how to get the edge over other traders using order flow. If you've been around the markets long enough, I'm sure you've read many books or watched videos or read, articles, and they all say, to be successful in the markets, you need to have an edge. You have to have an edge. But unfortunately, they don't really tell you how to get an edge. And I'm going to show you in this presentation how I've had an edge, how I've found my edge in the markets, how I was able to last, 25 years in the futures industry by using order flow, and that's my edge in the market. And hopefully, you can pick a few things up today that you can start applying to your trading, hopefully tomorrow. So, again, a brief disclaimer before we get started. I just want everyone to know this content is intended for educational and informational purposes only and should not be viewed as a solicitation or recommendation of any product, service, or trading strategy. No offer or solicitation to buy or sell securities, security derivatives, or futures product of any kind or any type of trading or investment advice, recommendation, or strategy is made, given, or in any manner endorsed by any NinjaTrader affiliate, and the information made here is not an offer of or solicitation of any kind. Just remember, futures, forex, and options trading contains substantial risk. Is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading. Only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Now we got that out of the way. You do have to understand, in trading, there are risks. There are financial risks. You can lose more money than you put into it. I just want you guys to come in and understand that. If you don't have an appetite for risk or appetite for potentially losing some money in the markets, maybe trading is not for you. And I'm just being honest, okay? I don't want people coming in with rose-colored glasses thinking trading is the way to it's going to change their lifestyle. It can, but just be aware of what you're getting into. So anyway, today you're in for a treat. I'm going to show you the easiest way to understand what's happening in the market so you can make better trading decisions tomorrow by adding order flow to your existing method of trading. Most people don't understand, when they use order flow, it doesn't mean you have to disregard every single thing you've learned in the past about trading, about the markets. No, you can start, putting pieces of the puzzle together. That's how I view the market, as a puzzle, and you're just you're putting it together, you're finding the pieces that fit together that make everything make sense. And my goal for you today is to explain why order flow matters. Some people say order flow is nonsense, order flow is rubbish. Well, okay, you could go back to analyzing the market using your astro signs, where is Mercury in retrograde or whatever. There's so many different ways to approach the market. That's what makes the market the market. Everyone has a different opinion on what's happening in the market, where is it going. And I'm just going to show you how you can read all that information of what is happening, people's different opinions of the market on a chart in the order flow in what's actually trading. Because actually, if you read Market Wizards, one of the great books on trading, it's interviews with traders, and each book's got about 20 different interviews. But if you've read it, you'll notice each person has a different way of approaching the market, and that's what makes the markets move is people's differences of opinions. And I'm going to also show you order flow made easy. Forget this 10,000 hour rule nonsense. I was just on Facebook, I think it was, and I saw a post, somebody talking about you'll only be successful if you put in 10,000 hours of screen time. I was like, oh my God, does this person even realize what 10,000 hours equates to? I don't think so. And I'm going to show you how to easily spot price rejection and use it to your advantage, how to use order flow to find market generated support and resistance levels. This is something I've been delving into a lot recently, working with traders on, is support and resistance levels on market generated activity, because the way people look at a chart is they look for an area that price has tested a few times and say, well, there's your support or there's your resistance. Well, sometimes, support is made and the price never retests it. If you're going to be waiting for the market to come retest a level so you can stick your neck out and say, hey, yeah, we've tested this level twice and we have support here. I'm going to show you how to read order flow, how to use order flow. So the first time it trades there, you can see, yes, there is support there, or yes, there is resistance there. And I'm going to show you a trade setup that risks just 3 ticks per trade. everyone always talks about you got to manage your risk. You got to keep your risk-reward ratio in line. You got to have 3 to 1. You got to have 4 to 1. People, they always come up with these magic numbers. And, the basic thing you got to know is, just, have a low risk and have, a good profit opportunity on the trade. And we'll show you how to do this without tons of screen time, without mathematical manipulation of price. And what that means is, if you use indicators, basic indicators such as moving average, all that's doing is just taking price, manipulating it, and, coming up with a number. And think about this for a second, okay? During the trading day, there's information that's always coming in. So what happened an hour ago? Say you're using a 60 period moving average. Okay, so on a 1 minute chart, that's the last 60 bars. Now, what happened 60 minutes ago to 50 minutes ago is oftentimes weighed just as important as what's happening now. But 20 minutes ago, there could have been a nice piece of information that caused the market to move. But yet you're still looking at everything that happened 40 minutes prior to that, and you're weighting it equal to what's actually happening now. And you really shouldn't, but hopefully you can understand that. Sometimes people just don't understand that when people say indicators are lagging the market, that's what that means. You're basically making trading decisions now based on information from an hour ago, or from 15 minutes ago, or for a half hour ago. And we'll show you how to do this without messy charts. Sometimes people, they think, the more indicators I have on a chart, the better chances I'll have to make money. And the opposite is true. The more messy your chart is, the more confused you get. So basically, my plan is to teach you to trade as a trader. It's not to be a signal taker in the sense that, we've crossed the 0 line on this oscillator, so it's time to buy. The great traders, that's not how they trade. They're traders. They trade based on what they're seeing in the market, what they're seeing in supply and demand, and other things. And if you stick around to the end, I got a special gift for you. It's my 150-page book called Trading Order Flow. So if you're new to order flow, this is a great place to start. And it's not a hardcover. You're not going to get a hardcover delivered to your mail like this. No, you just enter your email, and you'll get to the download page so you can download the book, and put it on your tablet, put it on your phone, and and read it at your leisure. Print it up, do whatever you like with it. So if there's one thing we can all agree on that we hate about trading, it's risk, right? You should always be looking to reduce your risk, not just in trading, but in life, actually. And I don't want you to take risks in your trading. I see risk and I run. I run as far away from the situation as possible. Just like when my wife gets angry, I do something maybe I shouldn't have done. That's a risk I took, and when I realize it's risk, I try to run away. But the markets are the same way. You don't be taking risky trades. You shouldn't be risking more than you could afford to lose. So you got to ask yourself, is trading for you? For some of us, yes. For others, no. You have to ask yourself, are you willing to take action? Are you really going to put what you've learned to work in the markets? What you've learned on how to analyze the markets, you got to make your trading decisions based off of it. In trading, there's no regular paycheck. Most people have jobs, and on the 15th and the 30th, you get your paycheck. You always have that to fall back on. But if you really want to make the move to trading, sometimes you don't have that cushion. And can you handle rejection? There's going to be times where you're wrong, period, in the market. You make a decision to buy or sell, and the opposite market just moves immediately against you. Okay, can you handle that? And do losing trades affect your psychology? Some people like to think that they are ice cold killers, stone cold killers, but as soon as a position starts going against them and they start thinking how much money they're losing, they freak out. Can you handle that? So the next step is the next series of questions to ask yourself: is order flow trading for you? For some, yes. For others, no. Are you willing to put in the time and effort to learn? It's not something that you can just sit down in front of a screen and figure it out. You need a little bit of structure. You need a bit of guidance. And that's what I'm here for today, is to give you that guidance. Ask yourself, are you a tire kicker? What I mean is, do you try something for a week and then give up on it rather than try to understand how it works or the methodology of it? You just want to look for the next shiny object, so to speak? And more importantly, do you want to understand what really moves the market? Now, I'm not talking about, you got to learn, the production, industrial production of Brazil or anything like that. No, but, you should understand the buying forces, the selling forces at work in the market, and inflection points, and how markets turn, and how you can take advantage of those. So, just briefly, who I am. Again, for those that are not familiar with me, I see some very familiar names here in the chat. But, there are some people that may be new here to myself, Michael Baltos. And, just a brief background. I was most recently, before I started Orderflows, I was a futures trader, vice president of futures trading at JP Morgan for 8 years. And before that, I was with Cargill for 4 years. Cargill is a big commodity trading firm. Most people think of it as, a farming company or food processing company. But, they actually supply about 25% of U.S. grain exports, about 30% of U.S. meat exports. They're involved in a lot of things. It's the largest privately held company in the United States, and they're a huge, huge trading firm. I also spent 3 years at Commerzbank, the big German bank, and a couple of years at EDF Man, which is also a commodity trading company. It's an English company. So if you're overseas, you'd know it. I'm sure most people have heard of Man Energy. And what's not on here is I started on the CME floor back in the early 90s with Dean Witter. And I left the trading floor to work upstairs on the Globex trading desk at that time. This is when Globex was just starting to take off. Project A, which was the CBOT, NYMEX Access, which was the NYMEX, the energies. And, it was exciting times. And, there's pictures of myself here just so, you could see, Hong Kong, Dubai, Singapore. Trading gives you the freedom to move around in the world, do things you want. I've got a wife, I've got 3 kids, and, it gives you freedom. It gives you freedom to do things, if you can put the pieces together and be successful at it. It gives you that freedom in life that we all want. I mean, honestly, when people hear that, wow, it was great, you worked 8 years at JP Morgan. Yeah, it was nice, but it was a lot of work. And trading is work. So in 2013, I left JP Morgan to spend more time with my family, and I had to make a decision in my life. I was in my 40s, early 40s then, and what do I want to do? Do I want to keep coming in at 5 in the morning and leaving at 5 at night, and sort of neglect my wife and daughter at the time, or do I want to concentrate on my family? So I said, trading has been good to me. I'm going to take some time off and try and figure out a way to give back. And I started writing a book called Trading Order Flow. And of course, I was trading for myself, but I was trading with the volume footprint chart from another company. It was a NinjaTrader add-on as well, but it was just a basic footprint chart. And I know, there's certain types of analysis that I do that could be done by the computer. And, just to highlight to me on a chart that, hey, you should buy or sell here, or take a closer look and, analyze it and then make your trading decision. So I created Orderflows to take the order flow analysis to the next level. And we programmed several tools into the volume footprint chart to help a trader see price rejection, price support, absorption, and other market nuances. And it runs on NinjaTrader 7 and NinjaTrader 8. And in all honesty, I was a big NinjaTrader 7 fan. I didn't think I would move as quickly as I did to NinjaTrader 8. I went kicking and screaming, but once I went to NinjaTrader 8, I haven't looked back on NinjaTrader 7. So if you haven't made that switch, you should seriously consider it. But again, this is not about me, it's about you. I want to show you how order flow analysis will help your trading in the least amount of time possible. You got to get from point A to point B as quickly as possible without getting lost. So let me be clear again, just state it out there. You have to make trading decisions. That's what trading is about. Order flow is not a red light, green light trading system. But when you understand order flow, you'll understand the market, and decisions will become crystal clear. You'll be able to make quicker trading decisions, and hopefully better ones. So why do most traders fail? Well, there's 3 main reasons. And how did I come up with these reasons is, when I was working on the institutional level, we'd never, you'd have traders that would lose their jobs because, they had a big position on and they lost money or something like that. But we never really said that the trader failed, because, maybe they were wildly successful before they worked for us. But as I started working with retail traders, I saw a lot more people were failing. And I've sort of wrote down that the three main reasons, the common denominators that a lot of people, reasons why I thought they were failing is: one, they don't understand the market; two, they took on too much risk; and three, they spend too much time learning and not enough time doing. And what I mean by that is, they sit in sim mode for, years, before they actually open an account and take a first trade with real money. And I'll tell you this right now, trading with real money versus trading on sim is incredibly different. I don't care what people say. When you have money on the line, when you got money that you have to use to, buy food or, pay the rent. I'm not saying trade with your rent money, but, if it's money that you can't afford to lose, your trading decisions are going to be a lot different. When I was working in the bank, yeah, I got a paycheck, but, there's also the more important thing that you'd always strive for is the bonus. So you want to have good results, right? And, to do that, you have to understand the markets. You have to take trades. You're not going to sit there and analyze, and wait for confirmation. No, you got to trade. So the first thing I'll talk about is why order flow matters. Now, again, some people will say, order flow is just a fad. It's a buzzword that everyone's trying to make money off of these days. Well, actually, that just shows you how narrow-minded they are, or maybe how new to trading that they are. That, actually order flow has been around in some form for a long time. One of the top books, if you search on Google, top books on trading, one book that invariably always comes up is Reminiscence of a Stock Operator, about Edwin, Lefebvre, back in the 20s. And, he was a tape reader. That's what order flow trading used to be called, tape reading. This guy sitting around the ticker tape reading it. So, order flow in some form has been around for a long time. So it is, it's nothing new. It's just nowadays with the advent of personal computing and what's available to traders as far as computing power, it's just taking that data, the time and sales data, and putting it in a different format that's more easier to understand and one that you can make better trading decisions. So order flow makes it easy to find hidden strength and weakness in the market, help determine if highs or lows may hold, helps you see market generate support and resistance levels, and determine if price is being rejected. Now again, this information is not available on a normal bar chart. Some people will say, well, yeah, you can see support and resistance levels on a bar chart, but what I'm getting at is I want you to see them as soon as they happen, not when the market trades a level and then comes back there an hour later, tests it, and then you can say, yeah, I got resistance here. No, I want you to see it the first time it trades so you can profit off of it. Sometimes it doesn't even come back and test those levels. So here's a normal candlestick chart. Yeah, it looks great. You got your red, you got your green, you got your wicks, so the high, the low, where the price opened, did it open and close higher or vice versa. And, honestly, when I first started trading back in the 90s, it was when candlesticks were really becoming popular, and I bought all the candlestick books, all the coffee table books, Steve Neeson's book, two of them, and there's a few others. I can't remember the names off the top of my head, but I thought they were the greatest thing. But when they work, they worked. But when they don't work, they don't work. It's one of those things that it's when it works, people always say, oh, you had this engulfing pattern here, that's why the market sold off. Well, they don't tell you about the 3 other engulfing patterns that just happened and the market didn't sell off. It's always, it's easy to play Monday morning quarterback and find the moves that happened on a candlestick. But, again, when you're making the decisions in real time, sometimes you don't get that information. Now, this is an order flow volume footprint chart for the same period. Okay. And you can see how the market rallied up, hit a level, and sold off. But on the order flow, if you're understanding what you're looking at, you can see that there's price resistance up here, and you sold off, right? Now, if you're looking at a candlestick chart or a bar chart, you're not going to know that there's resistance up here. All you see is, oh, the market hit a high and started selling off. But if you're reading the order flow, you know that there's resistance up here. You can get short and capture this move. Just as down here at this low, down here on the bottom right-hand corner, there's supportive buying coming in. And you can see how the market went up. But again, if you're using a normal bar chart or candlestick chart, you're not going to know that. But if you're using an order flow chart, you can see the volume, you can see the numbers that are going through, and you can make that decision. Just as here on the left-hand side, you can see price rejection as the market starts moving higher. So you know these low prices are being rejected by sellers. Sellers aren't interested anymore in selling at these low prices. And if the sellers aren't interested in selling, what's going to happen? Buyers are going to take control of the market, and market's going to rally. And what happens is you rally up to an area with resistance, and it sells off to an area of support, and it goes back up. Now, not every chart is as clean as this, but this is a good example. Again, you're not going to get that information necessarily by looking at a normal candlestick chart, because the way most people trade is they wait for the price to come back up here. It's got to come back up and test this level before they can confidently say, before they can confidently say, I think there is resistance here. But if you're reading the order flow, you know that there's resistance here, and you could capture this move, and hopefully capture the move back up to test that. But if you're waiting for resistance confirmation, waiting for it to test that level, what are you going to do if it doesn't test that level? You're going to be missing all the other trades that are given to you by the market. So the second thing I'll talk about is this 10,000 hour rule nonsense. Again, I was just on Facebook, and I saw some guy posting, I will be successful because I will spend 10,000 hours watching the market. Well, what's the point of watching the market if you don't know what to look for? And, I can understand, these, the studies, on athletes, tennis players, I think it was, like the top tennis players, one of the reasons why they're so good is because they spend 10,000 hours. But I got to tell you, there's, the cream in that crop, rose to the top. There's a lot of other players that are still kind of crummy that spend 10,000 hours. I could sit in front of a piano put 10,000 hours, and let me tell you, I'm not going to be that good at it. I'll be able to play, but I'm not going to be no Mozart or anything like that. But if you break down what 10,000 hours are, what it works out to, it's 8 hours a day, 5 days a week, 44 weeks of the year. It's 5.5 years. Okay. No one is going to hire you to do a job and give you 5 years, 5.5 years to figure it out. If you go to work at a company, you've got a grace period of, maybe 3 months or something, to figure out, be able to do your job. If you can't do it, they're not going to keep you around. They're not going to say, well, it's 10,000 hours before he gets good at his job. No, that's not going to happen. And, with the order flow, once you understand the basics of order flow, it'll really start, the pieces will start falling in place, and you'll begin to understand what you're looking at in the market. So this is an order flow volume footprint chart, and it looks intimidating, but let me just tell you, it's not. And there are three things, the three building blocks that I call them, that you need to focus on. The point of control, which is the point in the bar with the most volume, and it's usually got a rectangle around it. On NinjaTrader 8, I have a grade, so it's a little bit easier to see. The delta, which is on the bottom. And what the delta is, it's the net difference between aggressive buyers and aggressive sellers in that bar, and imbalances. And what's an imbalance is when you have more aggressive buyers than sellers on the bid and the offer. All right, markets are a two-way auction. So again, let me just explain it here so you can understand. Point of control, simple. The price level in a bar with the most volume. And why is that important? Is because as markets start to move, that will often become your support level for the next bar or your resistance level for the next bar. Delta is the net difference between aggressive buyers and aggressive sellers in a bar. So remember, markets are two-way auctions. So for example, here in the middle, you've got the bid side. This is all the volume traded on the bid. On the offer side, this is all the volume traded on the offer. Right? You add those two numbers up. If it's positive, you have positive delta, so you have net aggressive buyers. If it's negative, like this bar here, minus 43, you had more sellers, more aggressive sellers rather, in the bar. And what's the difference between aggressive buying and aggressive selling is you also have what's called passive buying and passive selling. So remember, market is a two-way auction. You have a bid, you have an offer. Say the market is one bid at 2. You're trying to buy ones, someone else is trying to sell 2s. Okay? Now, the market's not going to move unless one person, either the seller lowers his price and is aggressive and sells into the bid, or the buyer becomes aggressive and buys the offer. So when that happens, when the seller lowers his price to 1 and sells the 1 bid, then he is the aggressive seller. If the buyer went from 1 and moved his price up and bought the 2s, he is the aggressive buyer. Right? I think I said the wrong thing before. So when the seller at 2 goes down to 1, he's the aggressive seller. When the buyer at 1 moves his price up to 2, he's the aggressive buyer. And when imbalance is when you have more aggressive buyers than aggressive sellers, or more aggressive sellers than aggressive buyers in the two-way auction by at least 4 to 1. And what it looks like on the volume footprint chart is it'll be a blue number right in the bar, or a red number if it's aggressive selling. So buying will be blue number, aggressive selling will be a red number. So as you can see here, 1 against 119, that's more than 4 to 1. So the 119 is blue. That's your imbalance, a buying imbalance. Now the next price is 320 against 153. That's not, 153 against 320 is not more than 4 to 1, or the 320 is not more than 4 to 1 over the 153. So it's not a blue number, either one, or it's not a red number. Now a selling imbalance up here, you can see here it's a little cleaner. 31 against 145. That's a selling imbalance because you have more aggressive selling into that bid. 1 against 20. Only 1 traded on the offer, 20 traded on the bid. So you had a lot of aggressive sellers selling into that bid. 3 against 40. 3 is, 40 is more than 4 to 1 against 3. So you have more aggressive sellers into that bid. And there's something else. It's called a stacked imbalance. Just really quick. And what that is when you have 3 or more imbalances literally stacked on top of each other, 1, 2, 3 minimum. In this case, there's 4. You could have more, but generally, 3 is the cutoff. Now again, this ratio of 4 to 1, it's not set in stone. That's sort of like the industry standard. Now, when I launched the Orderflows Trader software, I created what I call ratios, and ratios help you determine if price levels are being rejected or defended. And there are 2 types of ratios. There's a ratio bounds high, which indicates price is being rejected, or a ratio bounds low, which indicates price is being defended. And how it looks on the volume footprint chart, this is the Orderflows Trader. Again, this is unique to my software. My software has a few extra order flow analysis tools that regular volume footprint charts just don't have. And that's why I created this order flows. Actually, I created it for my own use, but then I was talking to people, and people are like, hey, that's great, you should try getting it out there for the markets, for traders to use. That really wasn't my intention. I just wanted to keep it for myself. But then people kept bugging me and hounding me, said, hey, can you make it available? So I said sure. And actually some people have been starting copying it and adapting it to their own software. And oddly enough, they like to try and claim ownership to it. They want to say, oh, this is the order flow algo delimiter, or whatever garbage name, but it's just a simple thing. And what it does is it reads the order flow in the bar. And really simple, a number will appear above or below a bar. If it's a blue ratio, this is the number here. You can see the arrows pointing to them. So on a green bar, on a bar that closes higher than it opens, it will always appear below. If it's a red bar, a candle that opens and closes lower, it'll be above. And I did that because it's for me, it's a visual thing. If I'm looking to buy, I'm going to be looking below the bar to see what the number is. If I'm looking to sell, I'll be looking above to see what the number is. And if it's a black number, that's just your normal order flow, right? There's nothing special about it, because not at every price level or every bar there's going to be something actionable, something to make a decision off of. But on some bars, you're going to see a blue ratio, a blue number, and that's important to note, right? And again, take things in context of the market. Where it's appearing, are we at a swing low or a swing high? Things like that. Again, it's not a red light, green light system. You still got to make decisions. If you're seeing price support or price rejection at a low, yeah, you probably want to be taking a trade. If you see price resistance at a high, yeah, you probably want to be getting short. So again, where should you be looking at this? Anytime a market makes a high or a low, you should be asking yourself, is the market going higher or is the market going lower? And what are you going to look for? What's going to be your signs that the market's going to turn or the market's going to go higher? But so we'll talk about what causes the market to turn is either price resistance or price rejection. And what is price rejection? Again, it's you're getting high to a level, right? And price is quite high. If you're at the high of the day, prices are high, and traders will be asking, do I want to pay this price or not? If not, they're rejecting that price. So if you don't have buyers buying at those higher prices anymore, who's going to buy? The market's going to come off naturally. And you can see here on this chart, you got a bearish ratio. You got a ratio bounds high. It's above the bar. So I know that I should be looking at potentially getting short. And I can see the number. It's a blue number. So I know I got a blue ratio that, I could be taking that high and say to myself that, yeah, I think, I see prices being rejected. We can probably start to come off. And we do. We come off. And here's another one. We hit a swing high, big move up, positive delta, all green candles, aggressive buying. You see buying imbalances. Then you get up here. You got your lone red candle. Okay. Just because you have a red candle in the middle of a move up, doesn't necessarily mean the move is over. But if you can use the order flow, if you could read the order flow and see, hey, I've got price rejection up here. I know that traders are now rejecting these prices up here. You can be fairly confident in taking a short. And again, watch them at swing lows or at lows of the day. We're coming down here. It's just kind of bouncing around. You got a swing high here. It's price rejection. Come down here, price rejection. Test the level. Don't make a new low. Start going up. You see price rejection in this bar with the blue number, the blue ratio. It's have a blue ratio here. And then we start rallying quite nicely. And again, this is a 4-range chart. It works on it's an 8-range chart. This is an 8-range chart. It works on minute-based charts. It works on range-based charts. It works on basically any chart type. I don't look at wrinkle charts that much anymore. But I'm sure there are some people that do use it with my software, because I know I've gotten questions on it. And once they got my answer, they say, oh, okay, yeah, that makes sense now. But again, watch ratios at swing lows, and not just at the low, but watch what happens after a low. Okay, sometimes people are so fixated at looking at a low for signs that they miss the sign right after the low is made. And this is a perfect example. Okay, this market is selling off. You come down into a low. There's nothing on this low in the order flow telling you necessarily to get long. There is in the delta, but that's another presentation. But we start going up. But as you're starting to go up, you can see this bar here. You've got a bullish ratio, bullish ratio, bullish ratio. This is a ratio bounds high, ratio bounds low, ratio bounds high. Ratio bounds high indicates price rejection. This is ratio bounds low, indicates price support. This bar here is got price rejection. And what that means. Okay, so you're coming down into your low. You hit a low, start ticking up, and you're seeing traders rejecting this low. You start coming up, you see aggressive buy, strong support, passive buyers coming in, bidding this market. 1274 here that's a strong volume number. The market's not selling off anymore. So now you have support. You get up here, next bar. There's support down here. But you're also seeing price rejection. You don't have those traders trying to sell in and push it lower because they're rejecting those prices. And then the market moves higher. Just really quick, what I was talking about point of controls. On a market that's moving up, you should be watching the point of controls. Are we making higher point of controls on the move up? That's a sign of a move market, a healthy move up. Just as on a move down, you should be looking at point of controls being lower on the move down. And again, I was watching this movie. I don't remember what the movie was, but there's a great quote. It says, the guy says to the detective, you're looking for clues, but you're missing all the signs. And again, so if you're just looking at swing highs or swing lows specifically, you're missing, all the signs in the market that the market's telling you that this market's ready to rally, right? Because you're just looking, well, I'm only interested at the low to see what happened. Well, no, you take everything as it's happening and use that information to make your trading decision. And in the past, I used to calculate these ratios in my head and on a calculator. But one of the reasons why I created the Orderflows Trader software was to let the computer do the heavy lifting for me, do the calculations for me. So all I could have to do is I just got to look at the number, and it does that. It did that analysis, so I could say, okay, yeah, that's the number I should be looking at this, potentially start to move up. Or here you got price rejection that the market's going to start moving down. And by doing that calculation, it takes some of the heavy lifting off. And what I mean by that, it does the analysis for me that I know what numbers, what ratios I like. And if it's blue, it's a ratio that I like. Now I could look at other things, other nuances in the order flow to make trading decisions. And I've found, trading around the ratios have always given me low risk trading opportunities. I mean, this is how I've traded for years. Now, the third thing I'll talk about is how to easily spot price rejection and use it to your advantage. And again, price rejection doesn't always appear. Sometimes it's like finding a needle in a haystack. You need, if you could have a tool that will help you find that needle in the haystack sometimes, then great. So how do you spot price rejection? Well, it's a ratio bounds high. So it's a blue number. It's a certain type of blue number. Again, there's different types. There's a number that's above what I call, that's why it's called ratio bounds high, is it's above a certain number. So it's a higher number means price rejection. And the opposite is true for support. It's a ratio bounds low. But what I talk about is price rejection. So I'm looking for ratio bounds high. So basically a ratio above 30. So you see these other numbers here, 3, 5, 12.09, 1.01, 3. They're not blue. It's because they're not above 30. Now on this Orderflows Trader software, you could set what level you want. I have it set at 30. So I know that if it's above 30, it'll be blue. And the reason it's blue is to draw my attention to it. Okay, so here you have a market selling off. You get down to a low, and I got a ratio indicating price rejection. Then the market rallies up here. Okay, that's the beauty of order flow. You saw price was rejected here, so you can catch this move. You're not waiting for price to test it or anything like that. No, right there, right away, price was rejected. Okay, here's another example. Market just moving sideways, not doing much of anything. And all of a sudden you're seeing some signs of price rejection appear at this last bar. What happens? These lower prices here are starting to be rejected for the first time in how many bars? Starts moving higher, makes a new high, comes back in. What does it do? Comes back in, throws up another sign of price rejection. Then the market makes the move. Over the next 5 minutes, it rallies quite nicely. This is what I'm talking about when I say market generated information. So here, spotting price rejection. Here's a market. It was just sort of going sideways. Then you see a sign here. Price rejection is a bullish ratio. 203, 535. Right down here, right off this low. It's not on the low. It's right after the low. Then here you have a ratio bounds low, which indicates price support. Then you got another bar here with a bullish ratio, 43. It's a ratio bounds low. Sorry, a ratio bounds high. This 0.2112 is a ratio bounds low. Ratio bounds low is a number below 0.7 or whatever you set it at. I use 0.7, and that will indicate support. So you're rallying up, right? You got some price rejection, so you don't have sellers interested in selling. You get to this level, big buyers, people that support the market and move the market realize that, hey, these lower prices are being rejected. Market's going to start rallying, so they start bidding the market up. You have your support. Market tests that level, rejects that lower level, and what happens? Boom, these are those two bars right here. This one and this one is right here. You can see over the next, this is a minute chart, from 8:56 to 9:03. You get a nice, 3-point move over the next, 7 minutes. So, hopefully by now you should understand how to see price rejection in the market using order flow. So, the fourth thing I'll talk about is how to find market generated support and resistance levels. Again, the easy way is, the way most people do is, they look for a market. They like to look for areas on the chart. They look left, and that's fine. You look left, it's not going to kill you to look left on the chart. But they're looking for areas where the market likes to test it, and they'll say that's support or that's resistance. But if you use order flow, you can spot it the first time it happens. And why is that useful? Is because that's useful because when it trades there the first time, you can take a trade right then. You don't need to wait for the market to retest. If you want to wait, you could sit there, you throw your bids in there, for if it's support, or throw your offers in there if you know that's resistance, and let the market test those areas and then make the move. So here, price to support. This is a 1-minute crude chart. Come down in here, you have a bullish ratio at this low area, and it's a ratio bounds low, which indicates price support. So if you could get long right away, or you could wait for the retest, because you know that there is supportive buying here, chances are there may be supportive buying once you retest that area. So you could be sitting in here with a bid, so you're not waiting for it to come in here, test it, and then start rallying and say, yeah, hey, we retested that. No, you could be sitting right there to take advantage of it. I mean, you could take advantage of it as soon as you knew it happened. Because honestly, sometimes, the markets don't retest those lows, those support areas or those resistant areas. In this case, we did retest it and then made the move higher. This is an example. Market sold off quite nicely. Hit an area of support. It's a ratio bounds low. Market didn't test that level. I mean, it came down within a few ticks and then rallied. But again, if you're using order flow, you can see that there is supportive buying right here. Okay, so you can get long. You could also throw in another bid, somewhere in, closer to that low area for a retest. But again, people like to wait for the market to retest that level. In this case, the market never retested that level, and you never caught the move. But if you're using order flow, you could get long and you could catch that move. You could participate. Here's an example. Price resistance. So you got ratio bounds low here on the left-hand side, and you sort of come back up, test it, and then you start coming off again. And in this bar, right? Say you're not convinced that this is resistance for whatever reason. Say you're not convinced of this high as resistance. As you start coming off that high, you have a ratio bounds low, indicating that there is resistance up there. And there's people stopping the market. For whatever reason, people have supply to sell, and you can catch that. So again, if you missed it earlier, you can catch it as you start coming off. You can say, hey, there's resistance, and you can catch this nice move down. Again, this is also a 1-minute chart. You're talking a move from 64.08 down to 63.80s. That's a nice move over the next. You're just talking 1, 2, 3, 4, 5, 6 minutes. The next 5 minutes, you could get 20 some points out of the market. And one of the areas where people get lost on sometimes is when they think of support and resistance, they only think of it appearing at highs or lows, or swing highs or swing lows. But you have what's called supportive buying in the market. You have resistance selling in the market. And what that is on moves up, you have people bidding the market. They're supporting the market. Or on moves down, they're offering resistance. They got supply. And they're not necessarily pushing the market lower, but they're capping the market. They're putting their resistance out there. They're putting their offers out there. So if anybody wants to buy, they got to buy from them, and they got a lot of supply to sell. Just as supportive buying comes in, as the market starts moving higher, is you got people that are happy to pay, work a bid, if the market, if there's sellers just want to come in to to sell at their price, they're happy to take all that, and that's what supportive buying is. So oftentimes in moves up and moves down, you get supportive buying or resistance sellings on moves down. You can see how it appears here on this move higher. You have a ratio bounds low indicating supportive buying. You hit your swing high, you start coming off, you got resistance selling in here. 2 bars later, you test that area and you sell off. That's what supportive buying and resistance selling looks like. So the last thing I'll talk about is this trade setup that risks just 3 ticks per trade. Now, I'm not saying this is the holy grail or anything like that, because sometimes this trade doesn't even appear on the day. Again, it depends on your chart periodicity and the market you're trading. And sometimes there are you could have 2 or 3 losers, but you get a nice winner that makes it all up. I mean, but again, it's nothing's guaranteed in the markets. We all know that. And I call this trade the O2X trade. And why is it called the O2X? Is I'll get that in a minute. But it's a 3-tick stop setup, and it has very low risk because you know where you can hide behind when taking the position. And here's the rules, right? It's what you do is you look for the daily high or low, swing high or low, the ratio bounds high at that high, which indicates price rejection, or a ratio bounds low, which indicates price support. So basically, you're looking for a blue number at a high or a blue number at a low. You place your limit 2 ticks off the high or low to get into the trade. You place your stop 3 ticks away for your entry. So here it is. Here's an example, and this is why it's called the O2X. Is you have your low. Imagine you put a circle around it. It's called the O2X, not circle 2X, but You put your O around it. You place your stop 2 ticks off the low. You place your buy limit 2 ticks off that low. You place your stop just below that low. So you're risking 3 ticks, okay, from your entry price, your limit bid. So you can see here, it came back down, fills you, then rallies back up. And that's O2. The X is like on the treasure map. X marks the spot. Your profit target is your X. Here's another example. Here's your low. You got your bullish ratio. It's either a ratio bounds high or a ratio bounds low you're looking for. Basically, you're just looking for the blue number on the order flow. And that's your O. And you put your limit 2 ticks up off that high. And your stop just goes 1 tick below the low. So you're just risking 3 ticks. First time it came down, maybe you could have got something in there and rallied up. Second time, in this case, it did give you a second chance. And it made a nice little move higher again. So hopefully by now, you can see how powerful order flow analysis is. Do you think it's difficult or easy? Hopefully you'll think it's a lot easier than you first imagined. And again, everyone says keep it simple. I agree with that. Keep it simple, and order flow is about as simple as it gets. So if you found this helpful, I think you really like my Orderflows Trader software package. It's the easiest and fastest way to trade with order flow. And you should choose consistency and control of your trading. Again, trading is not based on luck or being special. Once you understand what's happening in the market, you'll find the market just makes sense. You don't have to spend 10,000 hours of screen time, taking unnecessary risk, and most importantly, wasting your money. I always see these people, yeah, I blew up 3 accounts. And, geez, why don't you learn how to trade first before you start trading and blowing up accounts? That's what I don't want you to do. I don't want you to blow up your accounts. I want you to, limit your risk, understand what's happening in the market, and make better trading decisions. Just a little backstory about myself. I worked in the future trading business, for 20, 25 years. What year are we now? We're 2018. I started in the early 90s. But before I got into it, I was managing a grocery store in Wise because when I went to college, I worked in a grocery store. And, after college, they offered me basically a management position, and the money was decent. When you're 21 years old, making in the 30,000s, you think you're a baller. But then I realized I had to make a decision: is this what I want to be doing with the rest of my life? Now again, there's nothing wrong with working in a grocery store. I still have a lot of friends that work in grocery stores, and they're quite successful. They live great lives. But it's not really what I wanted to do. I didn't want to do that. I had different aspirations in life. I wanted to become a trader, so I got a job on the CME floor making 25 cents above minimum wage because I worked for Dean Witter, and they figure, I guess, if they paid 25 cents more, they would get better quality people working for them. And the point of the story is you have to break your old habits if you want to make a change. So that's why I put together this package, the Orderflows Trader software package. So if you're ready to do this yourself, type yes in the chat. And what the Orderflows Trader software package is, it's software and education. So the software package portion of it is, you saw the charts in this presentation. They're generated with the Orderflows Trader, and it runs on NinjaTrader 7 or NinjaTrader 8. And it's a volume footprint chart, but what's a bit different is it has 4 pre-programmed order flow indicators programmed in it. Okay, and today I just talked about the ratio bounds high, ratio bounds low. There are other ones in there. If you go to my website, you can learn more about them. And I'll also give you my chart template, so your screen can look just like mine. That's where people give up on order flows. They can't even set up the charts properly sometimes, and because one, they don't know what to look at, and two, since they don't know what to look at, they don't know how to set up their charts, and they just give up on it. And it's a shame because order flow is a great way to approach the markets. So I'm going to give you also my chart template, so your charts can look just like mine. But again, having order flow trading software is one thing. The next thing is you have to know how to use it, right? Because what's the point of getting it, spending a lot of money on something that you don't know how to use? It's like buying, those fancy DSLR cameras, but running it in automatic mode. If that's the case, just use the camera on your phone. You don't need to spend $1,000 or so on a fancy camera with all the bells and whistles if you're just going to run it in automatic mode. And it's sort of the same thing as like with order flow. If you don't know how to use it, what's the point? Just stick to bar charts. But what I have for you is a lot of education. That's really what I think separates me from a lot of other softwares. You get a lot of education on how to trade with order flow, so how you know what to look for, the little nuances in the market and what nuances in the order flow. And so you're going to also get access to the Orderflows trading course, which I normally sell for $297, and I sell it like all the time on my website. Almost every day or two I get a sale on it, and it's $300. It's 20 lessons. It's 15 hours of video instruction, so you can download it to your phone, to your tablet, or whatever, to your PC, and watch it at your leisure and watch it over and over again. I didn't expect it to be so long, but I started recording these things. I wanted like a 6-hour course, but then there's just a lot of information I wanted to impart that it just ended up being 15 hours. So instead of watching it on Saturday afternoon, it'll be your Saturday and Sunday. But the real bonus to this whole package is the access to the Orderflows Inner Circle, which you'll get for free. It has 55 videos on advanced order flow analysis. It's on order flow analysis. It's not how to use a trend line, or something like that. No, it's on order flow. So if you're really interested in order flow, this is something you really want to consider getting access to. And I honestly, I don't really open it up for the public, maybe once or twice a year, if that, because I only want people that are serious about order flow in it, and the other bonus that's inside the inner circle is you get access to my indicators, my additional indicators, for free. The indicators I normally sell for anywhere between $200 to $300 to $400. You get those free, and whatever new indicators I release, members of the inner circle get for free. So I probably got one coming out in about 6 weeks. So, if you're a member of the inner circle, you'll get it. You'll get access to it at no additional charge. These are my proprietary tools and my knowledge, that you're not going to get anywhere else. So what is it? Add it all up. The Orderflows Trader software is sell for $899. The Orderflows trading course is $297. The inner circle is normally $997 when it's available. But for just a one-time payment, I sound like one of those infomercials for a one-time payment. Wait, there's more. But honestly, you gotta ask yourself, do you want to make a change in your trading? Do you want to make a change in your life? It's $1,250. You get access to all that information, and put it in perspective, right? What can you spend $1,250 on? You get the new iPhone X. Actually, I was reading that iPhone is going to phase out or discontinue the iPhone X this year. I think because they got another one coming out later this year. But yeah, then what? In the next year or two, you got to change your phone anyway. Would you rather spend it on something that you got to change, or invest it in yourself? Learn how to act, learn how to read what's going on in the markets. I always think it's one of those things. You should really spend it on yourself. It's nice to have a nice phone or something, but spend it on yourself. Again, go to orderflows.com/all-in. What it does, it takes you to this page. You scroll down, and it takes you to this button here. I mean, if you could read everything on the page. There's videos on there, and there's a lot of chart examples of the other indicators programmed in the Orderflows Trader. Click on I'm all in, and it takes you to PayPal, right? It's processed by PayPal. I don't get your credit card information or anything like that. I don't want that. It's handled all with PayPal. So, why you want to join Orderflows is because you see the power of order flow analysis and how it can change your trading. You want to understand what's happening in the markets. You're excited to find low-risk trading opportunities, and basically you want a life of freedom and fulfillment if you can make trading work for you. Now again, people say, well, it's expensive. It's really not. Money comes, money goes, right? If you really want something, you'll find the money for it. It's like if your neighbor that drives a Mercedes says, hey, I'll sell you my Mercedes for $5,000, and it's worth $50,000. You don't have the money, you'll find it, right? Because you're getting tremendous value out of that. And again, I'm not saying, max out your credit cards. No, use money that you have, but money comes, money goes. You're going to get paid in a couple of weeks. If you don't want to put money aside to actually learn something, learn a skill that, you could use, forever. Basically that's the decision you got to make. So thanks for watching. If you want to download my book, you go to orderflows.com/book.html. You'll have to enter your email. You'll be joining my list. so that, when I have any announcements or anything, you'll be messaged for it. Honestly, it's it's good to have. It's good to be on my list, I think. Because I do presentations quite frequently, and I try to keep presentations. I try to talk about a little something different each time. So hopefully you can pick up a nugget here and there out of the different presentations. So act now. Go to orderflows.com/all-in, and any questions, email mike@orderflows.com. And again, to buy the software, go to orderflows.com/all-in.html. So thanks everyone, and have a great day. Bye-bye.